What's going on, everybody? Michael Silva here. Since the whole Silicon Valley bank debacle, volatility has been spiking out of control and has been creating mayhem for stock market participants. And you're probably feeling that don't miss out, that FOMO feeling. And to be quite honest, you should see less confidence out there in the finance community when there is increased volatility. And that's what we have. Instead, you're getting extreme confidence and polar opposite takes. Jim Cramer, for instance, said, short this NASDAQ, invite me to your funeral. We got a lot to discuss on today's stock market brief. We're going to be diving into the daily expected moves. We're going to be into some hidden levels on Bookmap, some interesting takes on what's been going on with the balance sheet. Like I said, polar opposite takes out there. If you're new here, welcome to the show. We use technical analysis and intermarket analysis to get a good idea as to where the stock market may be headed next. If you haven't done so already, make sure to hit that thumbs up. It is greatly appreciated, and subscribe to the channel if you haven't done so already. Let's get into it. Well, hello there, everybody. Welcome back. So yesterday we showed this chart, and this chart, if you're new here, I'll just reiterate it once again. It's showing the economic cycle or business cycle in blue, stock market cycle in orange, and we were talking about, hey, a lot of people don't, I think, listen to the entire video, and they just kind of assume by the title they know exactly what I'm trying to say. But I said that the stock market, some data shows that we could be near a bottom, and not by price, but I mean by time when I meant that. So a lot of people said, no, bottom's not in. I'm not trying to predict where the bottom is or when the bottom will come, but we could very well be near it given what we're seeing as far as rotation goes. Technology, communication services, and discretionary, while we're heading into the recessionary and bottoming out, that's typically the time in the stock market where you have tech, communication services, and discretionary performing much better on a relative basis. And if you take a look here on a year-to-date basis, you are seeing communication services, technology, and consumer discretionary leading the way so far year-to-date. That's if we look at today's price action, you have technology up there, communication services, and well, financials definitely caught a bounce, and consumer discretionary there too as well. If you take a look at the Qs broke out of this descending broadening pattern, descending broadening wedge pattern, and it could be very well trying to come out that 310 right there. It did so on some big volume. What's crazy about this price action move on the Qs is that for the week is near a 2 standard deviation move on the week alone, which is interesting to me because also financials was the quite opposite of that. It was actually a 2 standard deviation move to the downside. If we take a look at the IWM came prior into this area, and we found some support and we're bouncing from those levels, but really we're just kind of range bound overall. The S&P 500 today was lifted off on lower volume, and we came into the upper weekly expected move. Now, this was a big day today in the markets, and what's the change? What's going on? Well, March 12th, remember the Federal Reserve Board, they announced it will make available additional funding to eligible depository institutions to help assure banks have ability to meet the needs for all their depositors. What they're talking about is the policy tool, the Bank Term Funding Program, BTFP. And you could see here the Fed balance sheet saw this large spike up, and this is where it's creating a lot of somewhat controversy on the FinTwit finance community. I'm going to give a couple of takes here. So this is Charlie. He said the spike was not due to asset purchases. Treasuries and mortgage-backed securities actually declined, but from a $303 billion increase in loans. That's part, of the Bank Term Funding Program, BTFP, and the rest credit extensions to banks, the discount window, and bridge loans. And you can see that right there on the screen. Danielle DiMartino Booth, somebody that I admire here, and one that I would listen to over many other, very emotional type tweets. This is what they said. Well, before any misinformation, I'm just going to go to where it's most important. The discount window at the Fed is open. The discount window borrowing increased $140 billion in 1 week, taking total to 152. Prior weekly record was 111. That was in the 2008 during the financial crisis. That was from business that said that. And additional 11.9 was borrowed from the the Fed's new bank term funding program. We just mentioned that. $142 billion in Fed loans, including loans that were extended to depository institutions established by the FDIC. The Federal Reserve loans to these depository institutions and are secured by the collateral, and the FDIC provides repayment guarantees. $7 billion in treasuries fell. $2 billion in mortgage-backed securities rolled off the Fed as their Fed's ongoing quantitative tightening program is continuing. Michael Kramer also mentioned that it isn't clear to me what this increase in the balance sheet means. It was in the form of loans, and seemingly that means that banks borrowing needed the money to shore their balance sheets, so this probably does not have the same effects of QE. Many people are saying we're back to QE, and some people are saying no, they're still tightening. This has something, it's not quite the same thing. And you can see that over here too. This is Jeffrey Snyder posted this chart, and basically it's showing us this. There will be those who will tell you this is a good thing, a good sign. The Fed is doing its job. Take a look at these comparisons. When primary credit use goes way up, bad things happen and have already happened. So this week is right here. That's pretty large. This was in 2020. That was a bad sign. And this was a bad sign here in the financial crisis. And we already know that there is a lot of bond market volatility taking place, people. So this is, we're above. This is the MOVE index. We're above where we were in the pandemic, and we're reaching up into levels that we haven't seen since the great financial crisis. And you can see that bonds, our yields, have been just absolutely bonkers all over the place. And you can see here today, it started down low and closed at around the highs, which if we start seeing this thing rip back up, I don't think that's going to be really great for tech stocks to see yields rip back up like that. But then you have also like Peter Schiff. He says, as I predicted, QE is back. Last week, the Fed's balance sheet swelled to $300 billion, wiping out 4 months of QT in 1 week. By the end of the month, the balance sheet could reach a new high. Rate hikes don't matter. Inflation is headed higher thanks to the bank bailouts. Here's somebody else, a charter market technician. The Fed added more dollars to its balance sheet last week than it did the week of October 1, 2008, aftermath of Lehman's collapse. The new stealth fifth round of QE erased the past 4 combined months of quantitative tightening. This is very bullish for equities, whether you agree with it or not. Which is funny because it's, okay, so it's bullish for equities, whether you agree with it or not. Okay, well, I guess we don't really know. I mean, it's definitely adding volatility in the markets overall. But what we're getting here is very intelligent people saying one thing about it, and then we're getting other intelligent people saying another thing about it. This is what I mean by, hey, like, it's creating mayhem for stock market participants. People don't actually know what's going to happen next. But what we do know is the Fed is important. And what the Fed has been telling us that they want to do is bring inflation down to their target rate of 2%. That hasn't changed yet, right? We have to hear what the Federal Reserve is going to say. And remember, to fight inflation, they're typically going to quantitative tightening and do rate hikes. And right now, the market is pricing in a probability of 25 basis points here in March, and then another 25 basis points in May. But then after that point, it looks like we go start the cutting phase, unless if something changes when Powell talks, and Powell will be talking soon. Now, this is where it gets important. All those are narratives, right? So we have very intelligent people from both sides telling us one thing, it's really bullish, and the other, hey, you know, calm down. It's nothing crazy right now. One thing that's certain is that you can just look at the volatility. Volatility is still gigantic. For example, I'm pulling up regional banks, KRE, and just take a look here at the expected moves for these different expirations. And I'm going out, let's say a month, okay, 1 month. Just 1 month, this volatility is at 7.16. That's on a $46 product. That's a big move in a month's time. So volatility hasn't chilled out. So if I show you what this looks like, that can bring the KRE back up to around 52.50 in a month, which is just retesting this broken head and shoulders pattern neckline, right? Or it can drop to fill this potential gap down here at around 40. These are gigantic moves that are being priced in because of this volatility. And I can show you here, this would be, oops, well, let me go back there. Okay, there we go. This was the pandemic head and shoulders that actually did a full measured move, actually undercut it. This was this bank run debacle, and it broke down. It hasn't reached a full measured move yet, but if it does, that full measured move is actually right where that monthly expected move is at. Now, why did the market rip today? Well, something from Wall Street Journal came out. It says 11 bank deposits, $30 billion in First Republic. Okay, so there was this news that dropped, this exclusive article from Wall Street Journal right at about this point looking at First Republic. And then all of a sudden out of nowhere, we got this, we got some crazy price action in FRC. It's pretty hilarious. I mean, unless if you're on the wrong side of it, I apologize, but it just ridiculous, okay? Be very careful with these stocks. I traded and I got halted 3 times, okay? And then I got out and I was like, oh, I'm done with this, okay? It ripped up, right? It halted. It ripped up. It halted. It ripped up. It halted. Boom. And then that wasn't even the majority of it. It went from down here at about 21 bucks, not even at the low, right? The low was at around 20. It jumped all the way to $40 in the matter of like an hour. That's it. 30 minutes basically. Okay? And then it started to subside off right there. This is crazy, people. Crazy. This is where you can get your portfolio's head lopped off. Okay? It's a very dangerous environment. If you take a look at the S&P 500, right when that article came out here, boom, it exploded higher, and then we turned into a trend day. This right here, people, when you get trend days, this is where you can make really good money intraday trading, but you need to be on the right side of the tape. So when you see moves like this and you see volume explode, you can start looking for pullbacks and then buy back into the strength. That is what I did today. It was just an incredible move overall in these products. So we got to just be, once again, very careful. Now, on yesterday's market brief, I didn't go into this, but I shared it on Twitter because I didn't add it on. And this right here is Bookmap. Bookmap takes level 2 or market depth data and it paints it on the screen. I have a link in at the description, but the pinned comment and the description. Bookmap offers my subscribers a discount to this software. Now, I posted this because I like to apply on ES the plus or minus expected move for ES. And then I like to look for these hidden levels of liquidity that are hiding out after the market closes. Now, this was the lower EM, this was the upper EM, and I want to show you why this is so important now. Look at how today's price action played out. It opened up, came into the lower daily expected move, right? I got to look at this daily now because of the daily expirations, those zero DTE options. And you can see it came right into that level, and then when it bounced up, it got back above the daily VWAP, and when the article came out, right at around this area, we exploded higher, and look at where price got caught up at. The upper daily expected move. So price the entire day stayed within these expected moves. This is why it's so critical to know this, is because, once again, there are so many narratives and so many polar opposites and creating all this mayhem for stock market participants, you know, and CNBC, the finance community, and all this stuff. But if you're just paying attention to what is the market pricing in as far as forward-looking volatility, you can get yourself a good idea of ranges of risk to pay attention to. And if you want to know how to pull this data, I have right there in the description. You can watch my video, then I show you how to do the math to do it really quickly on any brokerage platform, or if you use Thinkorswim, you can pull it automatically because they have their own proprietary calculation. Now, going into tomorrow's trading session, we are looking at a $52 expected move in ES. That is a large monkey right there, okay? Now, where would that put us? That would put us to around 40.50. It's actually right here if you want to look at the upper and then the lower, okay, 39.43. So I have them highlighted on the screen. And then this is where the market closed, right? Okay. But I'm also highlighting this 39.50 and this 40.37.50 area because there's some spikes right here in the order book telling us that there is some liquidity hiding out in these areas. So that is going to be something to pay attention to going into tomorrow's trading session. Now, it doesn't necessarily mean if price comes down here, it's just going to bounce right back up to the upper, or if it comes right here, it's going to bounce right down to the lower. These are just important levels to know because you might consider, hey, if I shorted down to here, I might look to cover some of my profits. Or if it moves up here, I might actually look to take some of my profits off the table. There's a bunch of different strategies and ways you can approach this, but it's just good to understand where risk, where the risk lies going into the next trading session using this implied volatility. Now, if we take a look at the SPY on the 15-minute time frame, we're looking at a plus or minus $4.3 expected move in the cash market. Now, price had that big move today above where? Above the 5-day moving average. So the 5-day moving average, it is declining. It held as resistance. Then we flagged a little bit here. We broke above it on that news. We saw this explosive move. And now, if we can hold price above these levels, guess what? It's going to start turning back around. So that's positive right there. Another positive note is notice how price, where it got hung up at. It got hung up at the month to date anchored VWAP. Okay, and then price exploded from there. It came back to back test that area. Not fully testing it, but it's right around there. And now the longer price stays there and we get good volume, this can start curling itself up too as well, which would be a positive sign giving the bulls back control. Okay, now going into tomorrow, where's the upper daily? It's 443. The lower is 391.97. That's the expected range of risk going into tomorrow's trading session. We're not too far off the weekly upper expected move. And if I apply a couple other indicators here, you can see the PMO down here. It's starting to flatten out to potentially curl, and the RSI is not too far from being in overbought conditions. So understand that if we get some gap up into this level, don't really have FOMO, right? You don't want to chase long at these levels. You want to see how price digests, right? You want to see price come down and maybe retest potentially this lower weekly expected move, or wait for the 5-day moving average to come to start turning up. So maybe it does do something like that. Maybe it comes and scares all the bears, right? And then it starts bouncing up, and then it starts going something like that, and then we start heading higher, okay? And then the 5-day moving average continues to move up and it becomes more bullish. Or, maybe price does that same thing and this kind of goes like this, and we just bounce back and forth and we break right back down. Those are possible scenarios to watch out for, but what you don't want to do is FOMO at specific key levels. Now, I want to go into some stock market indicator charts. Take a look here. This is the asset managers, just a survey of, how long are they, how are they bared up, and you can see here, right, there's a lot of people saying that's so bullish, right? An environment. Well, actually, sentiment is suggesting quite the opposite. We're getting a reading of 41.92% basically long. These asset managers are in their portfolios. So we'll see. Typically, when we get above these higher levels over here, as you can see, the blue arrows are pointing towards, that's when sentiment's pretty bullish. At least that's when it was bullish in 2022 and on. And you can see those actually, were a good contra indicator for markets to move down. Typically, when you go from under 50 to above 50, that's actually typically when you start to see a little bit more momentum. And then when it gets overly extended, that's when it starts to slow down again. Not really something you can trade off of, but it is just a good gauge as to where, hey, what are asset managers thinking? What are they doing right now? Now, I want to go into these BP charts. I'm going to go through a lot of them. So I'm going to explain what it is really quick. And then I'm going to go through the charts just incredibly quickly. There's like 10 or 15 of them here. Okay, so the BP chart is the bullish percent index. This is showing us the percent of stocks in the product, whatever product that I'm showing you, are on buy signals based off of these point and figure charts, the X and the O charts, okay? So this is the S&P 500. So it's basically saying, hey, 27, it means 27% of the stocks in the S&P 500 are on buy signals. And when things get overly extended to the downside, it can that could be a good contraindicator that we can see a potential bounce. I like to apply an RSI, and when things get oversold conditions, I also like to take my foot off the gas a little bit as well. And when things get overbought, well, I like to take my foot off the gas there as well. And they kind of oscillate, right? It oscillates from sold to overbought to oversold to potentially overbought at some time here too as well. And you can see that on the screen. So as it stands right now, RSI is in oversold conditions. As you can see also, it's down here pretty low too as well. And we're starting to see a little bit of an uptick there. So this coming out of it probably will happen somewhat, I would imagine, in the near future. Okay, so that's the bullish percent index there. The reason why I'm showing you this is because almost all the products are incredibly oversold. So go figure. You get this monster move, creates a lot of FOMO, creates a lot of volatility, but guess what? It could be as simple as this. Stocks bounce because they sold off. That's it, right? So take a look at the BPOEX. This is S&P 100, oversold conditions. Dow Jones Industrial Average, oversold conditions. NASDAQ Composite, oversold conditions. BPNDX, this was actually not an oversold conditions, but it was a positive divergence, which we discussed on a prior episode. That played out to the upside. Look at NYSE, a New York Stock Exchange bullish percent index, well oversold conditions. Discretionary, oversold conditions. Energy, oversold conditions. And by the way, look at this reading down here too, as well as energy stocks gotten clobbered. Financials, oversold conditions. Look at the reading, 14.93%. If we go back here, where were we last time during these times? Well, if I just draw a line that goes up, boom, we saw a little bit of bounce, then a sell-off. Right here, boom, that marked this bottom over here. Right here, boom, marked this bottom over here and started ripping up higher there too as well. So things got oversold, right? Take a look at healthcare. Bullish divergence. You have a higher low, lower high, oversold conditions there for healthcare. The industrial sector, oversold conditions, got completely clobbered. Okay, bullish percent index for technology. It's getting out of the oversold condition, but it was just recently there. Take a look at material sector, oversold conditions. Take a look at real estate, oversold conditions. So needless to say, yeah, the market's bouncing. Why? Well, because things have sold off. That's it. You don't need to overcomplicate things. Take a look at the summation index. The summation index is still pointing down. Parabolic SAR is still trending down too as well. We would have to see, obviously, more time pass, maybe see some more consolidation, maybe see this start to turn up to feel a little bit more confident, but we still have some pretty negative breadth there. Same thing goes with the NYSE summation index, still pointing down below that zero line. This actually crossed down through zero as we got up around that minus 300 reading, which is a pretty darn bearish signal, but we'll see here, maybe it's different this time, right? And maybe we can get a turn back up. But this has oversold condition. This is sold off, hard, really hard, right? We were talking about this lower high there in the breadth of the NYSE McClellan oscillator, right? So we had a lower internal reading while price action went higher. And look at price broke down from 16,000 down to 14,750 in a very short order. So yeah, things are bouncing. Mayhem's breaking out. Volatility is increasing. You got people pulling you back and forth. If you want to destroy that noise, just look at the volatility of what it's pricing in to get a good idea for yourself of what to expect for that day, for the week, or for the month. Hope that helps. See you later.